you're doing real estate, right? You got your agent, you got your loan officer, you got your inspector. I think that your CPA should be someone that you can bounce ideas off of and talk to before you go and make some of these big purchases or big decisions for yourself and your business.
You're listening to the Real FI Podcast, where we discuss time-tested tricks, techniques, and strategies for pursuing financial independence today so that we can enjoy a better tomorrow. Financial independence isn't about getting rich quick. It's about cultivating a foundation to grow financially, mentally, physically, and spiritually. Let's figure out how to kick the 9 to 5. Here are your hosts, Patrick and James.
Hello, everybody, and welcome back to another episode of the Real FI Podcast. I'm your host, Patrick McGrath. My co-host, James Rippion. How you doing today, James?
Good, man. No complaints over here.
Excellent. We got a great guest today. We got Heath Chavis, CPA. How's it going, Heath?
Very good. Thanks so much for having me.
Excellent. Well, James, get us started, man.
Yeah. So, Heath, tell us a little bit about your background, man. Fill in our listeners. Tell us your life story, where you started, how you got to be where you're at now. Just give us some details, start back as far back as you want to go and bring us up to date, bring us current.
Sounds good. So, name's Heath Chavis. I'm a CPA out of Maryland. I'm also a certified financial planner. So, I've been trying to do that with my clients, combine both services as they're pretty complementary. But a little bit about myself. From Baltimore, Maryland, grew up there, went to University of Maryland for college. After that, when I graduated, had a couple jobs at different CPA firms, worked with, clients who are just starting out all the way up to, clients that have hundreds of millions, if not billions of dollars, big firms, small firms. And about a couple years ago, started my own tax, accounting, and financial advisory practice. And just decided it was time for me to go out on my own. Had worked with a bunch of different places and try to take the best of everything from all there and bring that to my clients best I can.
So what motivated you to kind of start your own practice? It's no small feat to get off the W-2 train and take that risk to kind of just grow your own business, grow your own clients. I think
absolutely. So what I would do is, as I was working for other accounting practices, I had my own little side practice the whole time because I always felt that I never wanted to be just beholden to one employer for whatever I was doing. So felt that it was important for me to have an extra stream of income from multiple different sources. I've always had different types of odd jobs, trying to make sure that I have been able to not just be dependent on one person. It was something that I was always taught very young and have tried to implement in my life. So got to the point where I had enough clients on my own where I had a decent base and could say that, definitely going to be tough, but can go out and market myself and start working with the clients that I want to work with. And you really build something the way that I think it should be built. Personal service. A lot of accounting firms end up really just being, tax return shops and don't really give the type of personal service that I think, clients need and deserve. So try to build my practice working with small business owners, people that are heavily invested in real estate, to make sure that we're properly planning tax-wise and financial-wise, for them. Because like I said, they're all very intertwined. So as much as you can, buy or sell a property, if you're doing a 1031, or if you're starting your own business, making sure that you're not overpaying in taxes, that you're reducing your tax liability, and then making sure that with those tax savings, you're becoming financially free is what I really try to do with my clients.
So go ahead, James.
I was going to say, I can definitely attest to that. I mean, having the personal services for an accountant goes a long way. Full disclosure, Heath is my accountant. So we actually just got off a call earlier before this podcast talking about money. It's good conversations to have, but it's good when you can get someone on the phone, have that personal relationship, especially with something as big as taxes. the biggest bill anybody's ever going to pay is their tax bill. Some people think it's their primary residence, but when you look up how much you're paying annually in taxes, Uncle Sam's your number one bill. So having a good relationship with an accountant, definitely a great thing to work on.
Exactly. So what I was going to ask Heath is, for anyone out there who hasn't had an interaction with a CPA or a financial planner, kind of what's that first meeting look like, on what people need to bring to the table to kind of help you put a plan and a path together for them to be able to lower their tax liability and really get an overall understanding of their financial health.
Absolutely. So, yeah, I think your question kind of touched on a little bit. The first step comes from the client's end, making sure that they understand that they have gotten to the point where they really could use some professional assistance. Some people, if they're just coming out, or if they just have a W-2, tax situation is pretty simple. They don't really have any outside investments. It's not really much value that I can bring there. I can certainly help them with their financial planning and family planning, different things that they may need to do. But just from a pure tax perspective, if you just have a W-2 and you're an employee, sometimes there's not as much that I can do. But as you do start to accumulate additional wealth, a rental property, a business, a side business, anything that's there, the first step that I have when somebody reaches out to me is trying to fully understand their situation. Generally have a consultation with them, 15 minutes, 30 minutes, just to kind of get an idea of what they're doing. I'm a big trust but verify person. So I'll review their tax return from the prior year, making sure that they're not missing anything and I'm not overlooking anything, because a lot of times it's with other industries. If I'm buying a house or I'm doing something else, you don't know what you don't know. So sometimes when people are coming to me, they don't know what they don't know at first. So when you're starting a business, what's the best entity structure to have? When you're buying a house or a rental property, do I put it in an LLC? Do I own it personally? What do all these different things look like? And that's generally how I try to start my relationship with anybody, is understanding their situation to make sure it's a good fit from both ends. Because there are tons of different people out there, many different types of CPAs and other professionals. So you want to make sure that who you're working with is someone that you can get along with and you mesh well with.
It definitely sounds like you're doing something a little bit beyond just filing taxes. It sounds like you're a consultant of sorts for small business owners, helping them see the bigger picture of what their finances mean in their business and how to mitigate tax liabilities. It's not just about filing that return at the end of the year before April 15th.
And I don't think it should be. I think when you're becoming financially independent and you are going out on your own and working with someone for that, there's TurboTax for those things. Tax returns, the service have really become commoditized in my opinion. So there's only so far that can go. However, you got companies like Intuit where they're kind of bringing everything together and they're doing their best to do so. But when you just go out and you start Googling something, and you can really go down a rabbit hole. So I've done that research already. I have a very good idea of what I think is the best way or most appropriate way that something can be structured, whether it's a real estate transaction, a small business sale. When you start a business with other people, we can go through those different scenarios, and you can really make sure that you're being put in the best position possible.
All right, Heath. So all that makes a lot of sense. So I really kind of take my relationship with my CPA as kind of a partnership, right? You have a doctor when you're having a health issue, you've got all these different people in your life that are there to kind of help you out, especially when you're doing real estate, right? You got your agent, you got your loan officer, you got your inspector. I think that your CPA should be someone that you can bounce ideas off of and talk to before you go and make some of these big purchases or big decisions for yourself and your business. And it sounds like that is the type of service that you really offer. My only really experience before I got my most recent one was with one of those guys selling was it like whole life insurance kind of
Oh,
policies
yeah.
and everything like that when I was like 23, talked me into getting one of those. So that was kind of my only.
You're not the only one.
And I think that's probably a lot of other people's experiences out there too. And for someone, let's say there's somebody out there who's got 1 or 2 rental properties, they've made a purchase this year or they've sold one this year, someone like that, how often should they be speaking with their CPA to kind of get an idea of where they're at?
So it depends on the specific situation. When they're going through and they have 1 or 2 rental properties, I would assume before they buy the property, it's no more than a 5 or 10 minute call, or at least to me, a lot of times my clients will call me for 5 or 10 minutes, say this is what I'm thinking about doing, and I'll say, have you thought of this? Have you thought of that? These are the different potential tax implications or ways to get money out of your rental property, different things that you can do. How much of a down payment should you make if people are thinking about paying something off entirely? We talk about their mortgage rate and the opportunity cost of money, where if they put all their money and don't have a loan, it's fantastic, but money's so inexpensive right now that sometimes it's better to keep a loan. So all of that can really be accomplished in 5, 10, 15-minute conversations. So understanding somebody's specific situation, understanding their risk tolerance and what their emotional state is, because it's not all just numbers. A lot of time, everybody's got their different risk tolerance and what they're comfortable with. So understanding where that comes from, is certainly important. But getting to your point, how often does somebody talk to their CPA, or should they? I would say before any big transaction that you're going to do, I try to talk to my clients at least 2 to 4 times a year, depending on who the client is. Right now, I was saying before, there's not a ton that you can do if you just have a W-2 and say you have no rental properties, you just have a W-2. Right now it's open enrollment. So could you take advantage of dependent care? Could you do an HSA type plan at work? How do those work? What are they? Again, all of that, I try to make sure my clients know that they can call me, because everybody's, situation's different, companies offer different things. So making sure that they know the lines of communication are open to me, and I don't charge by the hour. I always try to come up with a fixed fee of what things are going to be throughout the year. So that way people are encouraged to call. They know they're not going to get a bill for, $150 for a 20-minute phone call or something, whatever comes that some people send. So
Exactly. I've gotten a few of those. So
a lot of people have, and that was one of the frustrating things when I worked for a CPA firm was, you always had, the client should always come first, in my opinion. When you do that, everything tends to work out.
Heath,
Yeah.
I don't know if you get the same feeling, but when I was an attorney, I still am an attorney technically, but it feels like a life long gone. I felt like it was hard to put everybody in a position to be happy at the end of the day. But I don't know how it is for you as a CPA. For example, as an attorney, people are suing each other's pants off. Everybody's upset with each other most of the time, except when you're doing transactional things. People can be happy at the end of the transaction, like if you're closing a real estate deal or you're selling a business. Those are joyous moments, and people get a lot of benefit from that. How would you rank people's just general interactions with CPAs? Is it generally positive, or is it generally negative? Is it something that they're not looking forward to, or is it something they appreciate at the end of the day because you're able to figure out ways to save money and provide value to them?
Yeah, I think that's you kind of hit right on it. Is what I try to make sure that I'm doing is bringing value to someone, where either through putting together a tax plan or taking some of the tax savings that they've had and coming up with a 5, 10, 15-year plan where we know that we're going to take these tax savings and put them to work for them so they don't have to work as hard in the future. They are going to have some sort of retirement and accomplish those financial goals. When people understand what the plan is, then I think that everybody's happy, because there's a fee for doing things like that, and the fees appropriate to make sure that they are certainly saving much more than they otherwise would be if they were not working with me. And whether it's through helping somebody through a 1031 transaction, where you'd be shocked, I know in this podcast, people that are listening to it, most people probably do know what a 1031 exchange is, but a lot of people out there have no idea what they are, which again is one of those reasons I always try to encourage my clients to call me, because based on their specific situation, it may or may not be appropriate, but at least they know the options out there once we get off the phone. So going through all those types of different scenarios is key. And if somebody can save $100,000 in capital gains tax, like somebody just did the other day, completely, within the realm of the law, and they can get a bigger, better property, everybody's very, very happy with that. So
I was talking to my wife earlier too, and we were having that discussion, and we were talking about, the fees paid to CPA. And I just came back to thinking, like, listen, like, Heath is going to save us a lot of money in the long run. And the fees are minuscule compared to the benefit you get when you see how compound returns on money work, especially with tax savings. You figure out that you can make contributions to an HSA. You figure out how to really work the 1031 exchange. Those compound returns on the tens to hundreds of thousands of dollars you save are magnitudes greater than the fees that you would pay to get those words of advice. So I think it probably matters how somebody perceives the value they're going to get. They're either looking at the dollars they're spending today and prefer to just do the TurboTax and not really potentially not seeing the benefit in the future by thinking kind of the bigger picture.
Well, it's almost with any professional. You try to make sure that you're a valuable asset to someone as opposed to a sunk cost expense. And I've tried to frame myself and my practice that way. And it's a way of, just expressing that value, making sure that people can call, because if they're not spreading yourself too thin, if you want to make sure people can call, and I want to be available, kind of not 24/7, but often enough whenever anybody needs. So I understand people are busy during the day. So try to make myself available, a couple evenings a week as well, to make sure that everything gets done and accomplished for whoever it needs to be done for, and that they know that they can always reach out.
That's really great. So when you're looking at these clients, you said you've got clients, a couple 100,000 net worth to, million, tens of millions. What are some of the common things that you're seeing from these successful, high net worth individuals?
The main thing, not the main thing, but one of the biggest things is, it's almost like when you listen to any of these interviews from very, very successful people, they work very hard. They're very, very intelligent for the most part. But it's where luck meets opportunity, and they're able to take advantage of an opportunity that's presented to them, right place, right time, but not just that, it's them being able to take advantage of it, because maybe they're only one out of 30 people or 50 people that could take advantage of the situation that they're in. Many of them, I've helped them, people that I've been working with for the past, because I told you I've had my own practice for a couple of years, but I've been working with people for the past 12 to 15 years. I've helped them start their small businesses, and they started from nothing, and now they've got a business that grosses $8 to $10 million a year. Very, very hard work. Anybody who's entrepreneurial, they know that they're going to keep a good set of books. We're going to be able to make sure that we have an appropriate structure for them, but they work very, very hard is, what I've seen for the most part. You get to a point where you definitely work smarter, not always, harder, but definitely there's an intelligence factor and there's a work ethic that I found that many entrepreneurs have more often than not for becoming successful.
I think that's huge right there, because there's so many people out there that think there's, a kind of get rich quick thing, or it doesn't necessarily take hard work, or they just don't want to do it. And the fact of the matter is, you've got to put in the time, you've got to put in the effort, whether it's the research, and it's in 9 times out of 10, it's doing all of those things together, being diligent, putting in the time, going above and beyond, working nights and weekends. You've got to grind and hustle, those first couple of years until you're going to start seeing things pay off. And it's the people that stick through it, which is obviously what you've seen, who end up actually, making it out. And And once you're successful, you can say, I was in the right place at the right time. But,
No, it's taking advantage of it, though. You certainly do have
Yeah.
to be in the right place at the right time, but you have to be able to recognize and take advantage of that. And you see it now with cryptocurrency, right? You've got some people that they get rich quick, and it's fantastic. It doesn't happen often. I think that's more the exception than the norm, though.
Exactly. And anyone out there who has, made it rich or made a significant amount of money with their cryptocurrency, 100% needs to reach out to their tax advisor, because I don't know about you, but I think the past 2 years, when you go to do your taxes, they have a little form that says, have you invested in cryptocurrency in the last year?
I think it's
Check
page
yes or
one
no.
now.
Page
It
one.
is the first page on the return, right after, do
First-
you want to donate to the presidential campaign?
Janet Yellen wants to know what you own. Don't forget it.
First on the page. So anyone out there with those SHIB gains, with those Bitcoin gains from this year, and that are be going into Q4, definitely reach out to a CPA to
I
do
know
that.
our listeners don't have that problem because they have diamond hands and they're never going to sell. They're strong-willed individuals.
I'm paper hands Pat over here. I'm not gonna lie, but get in, get out, baby. But yeah,
Speaking about crypto, though, let's just say that I don't want to pay taxes on it, or I want to minimize taxes, or I want to take actions that are tax favorable, specifically with cryptocurrencies, and in my case, just Bitcoin. What are some things that we can do and look to do to kind of plan along the volatility of what is cryptocurrency?
Yeah, absolutely. So cryptocurrency is going to be treated, when you buy it, you want to make sure that you have a good, spreadsheet of, unless you're doing it like Robinhood or something, but if you're just buying it yourself, making sure you have the basis and you know what you bought and sold your cryptocurrencies for, and what date you sold it, how much fees you paid, because every time you buy and sell, you've got to pay some fees for that. But the biggest thing, the biggest, quote unquote loophole that I've seen is, if you do have cryptocurrency and you're able to sell it at a loss, and you have losses in your cryptocurrency, paper losses, you can sell that cryptocurrency and then buy it right back a couple minutes later. And it's not subject to the wash sale rules that many securities, stocks, mutual funds, and ETFs are. Now, a wash sale is when you sell a security at a loss, you can't buy it back for at least 30 days. Or if you do buy it back within 30 days, you do not get credit for the loss on your tax return. The reason cryptocurrency is different is because the IRS has designated it as a commodity as opposed to a security. So because of the IRS's designation, you can take advantage of some of those paper cryptocurrency losses to offset some of those gains if you are so inclined to sell. So if you are not James and you're inclined to sell into some of this and you would like to reduce some of the taxes, you can find some of those paper losses that have been there, sell those, buy it right back. You will have to pay some of those fees that are involved, the transaction fees, but oftentimes if you're able to take a $20,000 loss on your tax return, that more than offsets any kind of fees that you would have to pay for that. So
just
going through and looking at it, that's one really big way to save some money on cryptocurrency transactions.
So just to put a number on it, then let's say someone gets into all the hype. Bitcoin's at $65,000, whatever it's at. They FOMO in. They got some cash sitting on the sidelines. They're like, I'm not waiting for it to go up, down. I'm just going to buy right in. They buy it in 65. Let's just say it drops. It gets a 50% haircut down to 30. So now they've got this $30,000 paper loss. So what you're saying is that they would sell it at 30 and then immediately buy back in at 30. And then after that point, whatever happens, happens. But now they're carrying this $30,000 loss. What happens with that? How's that applied in regards to taxes? What's the importance of that loss?
So you can take up to a $3,000 loss over capital gains each year. So if they continue to buy cryptocurrency and never sell, they have this $30,000 loss that they can carry over for the next 10 years. If later in the year, there was another coin that they purchased, maybe the cat lady coin, or cat girl coin, and then they hit it big over the course of a weekend, and they made $25,000 on it. They can use that $30,000 loss from the Bitcoin sale that they still have to offset that $25,000 gain on the cat girl sale or cat girl coin or whatever it was called. So that way they're not paying any taxes on that gain from the other coin because they were able to offset that gain with the loss that they were able to recognize.
That's extremely interesting. Now, what about converting? Is that also considered a sale too? Because I know that you can basically convert,
Yes.
one cryptocurrency into another cryptocurrency. You didn't sell it technically, but
Technically you did.
That is a
Right.
sale, right?
Correct. That is qualified as a sale. It's just, like if you rebalance your portfolio, moved out of one stock and into another, and that would be one of the areas where this quote unquote wash sale or non-wash sale strategy would come into play, because if you did want to convert some coins and you had gains, you could recognize losses on other coins to offset some of those gains.
Just
That's
imagine
if you have losses. Hopefully, nobody's trading this obviously to lose money, but
exactly.
if you review your portfolio of cryptocurrencies and there are losses in there, then you can offset that. Or if you have other regular securities, right?
Well,
If you have losses, you can use those as long as you don't buy them back.
You can go onto any of the major trading exchanges and click on the taxes section, and it will generate a nice report for you of every transaction that you've ever done.
And for those who can't see, Patrick is holding up all his losses that he's got to not pay taxes on.
There's some of these, Bitcoin back in 2018, stuff like that on there.
There you go.
But yeah, so that's good. I kind of wanted to touch base on that one for sure, because I know there's a lot of
very
people.
Topical right now. A lot of people are investing into cryptocurrencies, and that's definitely been one of the things that I've seen more and more. And people ask me all the time, as not just a CPA, but also as a certified financial planner, how much of my money should really be in cryptocurrency? And to me, my basic answer will be anywhere from 1 to 5% of what you are, depending on how strongly you think of it. That's an appropriate amount to be in there if you at least want to participate in there. Some people want to do more, some want to do less, but it's kind of like anything. It's you have to be comfortable to lose whatever you're investing in there.
Exactly.
So
makes a ton of sense.
keeping on the topical segment, we're going to make this a little political. We got conversations coming out of Treasury and Congress talking about unrealized capital gains taxes. Don't necessarily need to know what your political stance is, but talk to us a little bit about what that means. How does this apply? Is this like a realistic thing that people are just chatting about, or is this kind of just political showmanship? What are your thoughts on this unrealized capital gains tax?
My thoughts would be, I would love to see how they're going to implement it, because if you can obviously tax people on unrealized gains, but what will happen if there are huge unrealized losses? How does that work? What do the mechanisms do? So I always try not to opine on any of these until I actually see some of the text and the proposals that come out, because I'm just not sure how they would implement that. And I'm not sure anybody is, because I don't know if there is any real concrete proposal out there on how they would do that. But the interesting thing that I have been doing with a lot of my clients is, because obviously, whichever way you lie, it doesn't really matter. There are political realities out there that taxes may go up, nothing may be done. You never know. So what I've been telling my clients is, we at least have a conversation about it, and where most of the time you'd want to defer income as long as possible to defer the taxes on it. If tax rates are going to go up, sometimes it may be better to accelerate income into the current year, which is a little, it's kind of counterintuitive. But if you're going to pay a lower tax rate on that money, even paying it this year or tax on it in 2021, may be better than deferring it till 2022. So those are more the conversations that I've had with my clients, is depending, do I buy that new car this year, or do I buy it next year? Do I take that bonus depreciation on the piece of equipment or machine that I'm buying this year, or do I do it next year? And that's really the main, reason to have these conversations, quarterly or semi-annually, depending on the type of client it is, because these are all things that go on, and we've seen things change by the hour, by the minute, by the week, depending on what Congress is doing. So I have clients of all different political persuasions, and a lot of times they're more than happy to let me know what their views are, but I always try to stay very apolitical through all of those things, because there are just certain realities that you may or may not be able to change, but you have to be able to know what they may be, what proposals are out there, and be able to have a plan to adapt either way.
Well, that's good to know, because I just didn't have any idea how practical this was to be implemented, how realistic it is. Interesting concept nonetheless.
It definitely is. And that's where, like I said, I always try to make sure that I at least stay on top of what proposals are potentially out there. And just to know what's going to affect other people, because you're going to have different credits out there when you start to look at, I have some clients who own restaurants. So there was a specific credit out there last year for restaurant owners where they could apply for different grants in DC. So understanding the industries that you work with and being able to stay on top of those types of things can be very, very valuable to a lot of people.
Exactly.
I hope that was a very politically correct answer. I know
it was. I really wanted to ask if for any of your high net worth individuals on both political leaning sides, are both of them fierce and want to pay as least taxes as possible, or does one side prefer to not pay as much than the other?
It really depends on personality, which is interesting. Some people are more than happy. They say, I've been very successful and I'm happy to pay my, quote unquote, fair share. And if people deem that fair share needs to be higher, they're happy to pay it. And then there are others who, despite earning, $5 to $10 million a year, think that there's a way to, pay zero taxes. A way to really do that I know of is to be in real estate, where you're taking huge depreciation losses on different things. So real estate is a fantastic way. Exactly. If you can have zero taxable income, that's one way to do it. But I think that I also find it interesting when I have people that I have been working with for a while, where they start off, obviously at the lower end of the income spectrum, and then they start to realize as they become more successful, the amount of taxes that they need to pay. And many of them, become surprised by that. As much as we're able to reduce their liability through different planning mechanisms that we utilize, there's still a time where if you have, X dollars of income, there's going to be some tax liability that's owed, and making sure that doesn't come as a surprise to people. It's to see people's reactions sometimes is a favorite part of my day.
Exactly. No, I mean, I don't care who you are, when you're making a little bit, 10%, 15% doesn't seem that much. But then when you're making a big bit, 10% or 15%, you're like, whoa, that could be, $1.5 million, plus.
Depending on who it is. Yep.
So I've been seeing this kind of new trend, not necessarily new trend, but new trend for people that they talk about on TikTok a lot, isn't about life insurance. Like everybody on there is pitching life insurance to where they're saying high net worth individuals are basically putting their money in these life insurance plans and then loaning the money back to themselves, acting as their own bank.
Yep.
And I think this concept is extremely interesting, but I haven't really dove into it too much. I don't know if you know anything about that, but I would love to get a high level aspect of how someone like myself might be able to participate in that and the benefits.
Yeah, absolutely. So, in addition, I have my life insurance licenses as well. And, as part of the financial planning process, I help my clients make sure that they're having an appropriate policy for them and their family planning and also financial planning. So there are two main types of life insurance. You've got term insurance, which is just for a set term of time, 10, 20, 30 years. It's going to be the least expensive type of insurance and not what we're talking about here. The second type of insurance is permanent insurance.
Hmm.
There are two main types of permanent insurance. There's whole life insurance, and then there's universal life insurance. So the one that you're talking about is more along the universal life insurance side.
Gotcha.
And where I find that to be appropriate and where I've utilized that for my clients is definitely on the higher net worth side.
We're
Life
talking like
insurance,
$1 million net worth, 5 million, 10 million.
I'd say at least if you have at least 2 to 3 million, you can start to have this conversation, because I try not to use life insurance as an investment. And this is just a personal philosophy. Some people will think differently, but life insurance is a very expensive investment. If you're going to be doing it, I think that you should be filling up all of your other qualified accounts first, whether that's a 401k, SEP IRA, solo 401k, IRA, whatever it is. All of your other qualified accounts should be filled up. You should have a healthy emergency fund. And you really shouldn't need to have this money. This is more of a luxury type investment because it is such an expensive investment. But
Well, that's kind of where that's why I really was interested in that, because I mean, people are pushing this like really hard.
when you have to remember, it is more expensive to get the premium on this policy. Life insurance salesmen get a commission really of the first year premium of whatever it is. So there's an incentive to do that. But I think that it's a great thing to do, because when the way that you structure this type of policy is you have the lowest death benefit for the highest amount of premium that you can afford. And the reason to do it that way is because the way these life insurance policies are structured is that there's a life insurance component, and then there's an underlying account. The underlying account can be invested into various different investments, whether it's a security, mutual fund, stock, ETF, whatever the insurance company will allow you to do. Different insurance companies allow different investments in their life insurance policies. So if you, for instance, are able to put in a $50,000 premium every year, but only 5,000 of that is going to the cost of insurance, 45,000 of that can go to this underlying account. The underlying account will grow tax-free, and you can then take those funds out as a loan against your policy tax-free. It just reduces the death benefit that you have. So when you talk about being your own bank, if you're able to put in $50,000 a year for the next 20 years, now you've got $1 million, or probably a lot more, that's built up in this life insurance policy and the cash value, which you can then take a loan against the policy tax-free, and it just reduces your death benefit. So when you're going to use a policy like that, it can certainly be a great tool to finance real estate, finance your lifestyle. If you need to take a distribution from a qualified plan in retirement when the market's down, so you're not reducing that investment account or that IRA retirement account when the market's down in a dip. So it can be used for a few different things, but in my opinion, it's a very expensive type of investment where it's definitely appropriate for people that have in the millions of net worth, but not necessarily for a 23-year-old kid coming out of school.
I got you. And I appreciate that, because I really, even for myself, because I was like, is this something that I should start considering, for myself? And it's, again, it's having those conversations, with your financial planner, with your CPA, talking about these types of things so you can put a plan, have a roadmap in place to go, hey, that's a great option. I could see how you could utilize that, but you need to do, B, C, and D first, Or
somebody maybe going to have, they may, have a large inheritance that's coming to them, so they don't need to worry about retirement accounts. You say, you know what, hey, this is appropriate for you in that point, because
exactly,
we're so many different types of situations out there, but it definitely involves, sometimes I'm a little too forward in what those conversations are, and trying to get as much information as possible, because if I don't know the full situation, it makes it very difficult to advise one way or the other.
Well, I think that should be, you never lie to your doctor, right, about your health, and you definitely shouldn't lie to your CPA, your financial planner, or your wife or husband. Those are the three people out there.
One of the
CPA
commandments,
first.
right? Just don't lie.
Yeah, I mean, you never know. Depending on your situation, you might need your CPA to help you with the wife or the husband, but
There you go.
Yeah, I mean, you need to be honest about those types of things. If you honestly want to grow your wealth and, be financially independent and be successful, you need to have that full in-depth scope of what's going on, because I'm sure you've had some conversations where people thought everything was rosy and the money was flowing in, and you've got people that are high income earners that aren't doing as well as they thought. Um,
But it
I'm
comes
sure
down
that.
to, it does also, I mean, it comes down to your household budget, lifestyle creep. People start to do a little bit better and, hey, now I want a boat, or I want that second home, or I want something else. It's, definitely being able to live within your means and having a plan to say, if this is the place I want to get to, making sure that you're not spending more than what you're making. You're putting away that, I try to tell people to put away 20% of your gross income. Well, it's tough to do for a lot of people. So, whatever you can start with, but if you can get up to that 20% or 15% of your gross income, after a few years, as that starts to accumulate, whether you're investing in the stock market, your retirement account, real estate, whatever it may be, you're going to be able to become financially free. And that's all. If you're making $60,000 or 600,000 or 6 million, as long as you can be financially free and you're not spending more than what you're making, I think that ends up really being the key for most people.
I think that's super important. And I think you were touching on this earlier. You got to fill up your buckets first in the priority that they're need to be filled. So, contribute to your Roth IRA or your traditional IRA, pay up on your HSA, make those contributions beforehand. So you're doing that saving up front. You're saving and investing in your financial planning should not be the afterthought. It should be your first thought.
Pay yourself first.
Yep.
Pay yourself first, and then anything else is left over for you.
Exactly.
What I always try to tell people.
So I was terrible at doing this. Everybody thinks that they can have a couple savings accounts in their in their online banking, and they're never going to transfer the money when they're running low. So what I did is I went to my company and I asked them to split my check, and I created a separate savings account at a bank that I don't have a debit or online banking to. And I got them to put the first 10% of my check went into that account, and the rest of my check went into my one that I have my online app. And I started at 10, and I said, hey, if I can live like this for 2 months, I'll up it. And I upped it to 15. And then 2 months later, I upped it to 20. I got up to 25%. I was saving 25% of, my hourly and commission pay for almost 4 years. And that's how I saved to invest in real estate and invest in cryptocurrencies and everything else, was because I couldn't see it. And I physically had to drive to the bank to go pull out that money. And that right now it's about an hour away from me. That hour drive, you're like, do I really need this? And
That's if you can learn to live on less and have a budget that what you're doing, and you had a goal in mind, which is really what it all starts, having that goal, and then how do you reach that goal?
And people spend what's in their account, most people, so if it's not there and you don't know it's there, like, hey, and then all of a sudden, like you said, 10 to 15% in a couple months. It doesn't matter if you're making $12 an hour or $20,000 an hour. In a couple months, all of a sudden, you now have a couple $1,000s, and you're on your way. So,
Patrick, what you're talking about is great for building great habits. Like, that's rule number one, is putting friction in between you and your bad habit. If you're trying to, stop drinking, maybe don't put the beers in an accessible place. If you're trying to save money, make sure it's going out to somewhere that's hard to get your hands on easily. So you got to drive an hour. If you're trying to not sell your investments, maybe you should work with a financial advisor. If you're just trading in and out of stocks and assets arbitrarily. And that's what these professional advisors do. They act as that friction between you and bad decision making, and they operate to enforce good habits. So I think that's key for people to key in on and look at and examine with their own personal financial situations, is how do you make those bad decisions harder to do? And that's going to be, that money comes in, and sometimes it doesn't even come in. It goes directly somewhere else. I did the same thing with my investment my income when it came in, it just went directly, automatically, the same day I got my check, into all the investment accounts that it was going to, the 529s, the Roths, the regular investment accounts. Came in and went out just as fast. And then whatever's left is what you have to live on and, have fun with.
That's the smartest way to do it, to not even touch it. You don't even have access to it. It's just there. My dad always said, you pay yourself first after the government, because they take taxes out of your check before you get it. So, pay yourself first. And no one ever regretted paying themselves first. And I think that's huge, especially now, around tax time, when tax time's coming up. You got to have a decent savings in case you had a really great year and now you owe the government money, and hopefully you have a good CPA or financial planner and you've been going to your meetings, you've been mitigating that. But you have to have the emergency fund. You've got to have those funds that you're putting aside. And I think that's huge for everybody listening out there. I think that was great. I think it's time for us to get into the big picture. So James, why don't you kick us off on that, man?
Cool. So Heath, when you're communicating with people who are on their path to working towards financial independence, what's that one thing that you think you could tell them that would make the biggest difference if they implemented it along their journey? What's that one thing that they should focus on first?
The first thing is to make sure, I always give somebody a financial questionnaire, because you want to have your goals identified. The goals will change from the time when you're young to when you have kids, but you need to have something that you're actually working towards, because it's great to save money. It's great to have it accumulate. It's good to have it be there. But if it's not going towards anything, you're not working towards anything, it makes it that much harder to stay motivated and working towards that goal, whatever it may be.
Yeah, I think that's huge. Everybody out there's got to have their goals aligned with, what they're working towards. So there's a ton of podcasts out there. There's a ton of books out there, Instagram influencers, all this kind of stuff. If you had to pick, one podcast or news source that you would recommend to anyone out there that's got great nuggets and would help them out, and possibly, one book that, made a huge impact on you and how you view finance, what would they be?
Funny, I didn't really know this question was coming, but I'm glad I know now. The first one is, I think a great book is the Millionaire Next Door. I think it's a great book. Hold on 1 second. Let me get my dog to go upstairs real quick.
All right, so there's a million podcasts out there, tons of books, Instagram influencers, all of that. If you had to pick, one podcast or news source that is providing great content that's going to help people out, and what book?
This one?
Yeah, what book? Really, you could say this one, of course. Changing lives. And what book, really made an impact on you and your financial journey?
Absolutely. Well, when I was young, the Millionaire Next Door, I was actually walking through Costco, saw it sitting on the shelf, and thought it was not really. I was, I think, 11 or 12. Did not really realize what it was about. Thought it was some sort of murder mystery or something. But turned out to be a great book about finances. And it was just more along the lines of how do you become financially independent? How does the gas station worker become a millionaire making $40,000? It doesn't matter how much you make, you can always start to accumulate as long as you pay yourself, and the time value of money is excellent. So I thought that was a great book. I think everybody should read that. The other one is a podcast that I've started listening to called the Money Guy podcast, and the gentleman is a CPA, or was a CPA, but now he's just a financial advisor. But has a lot of good nuggets of information with things that are out there that I find to be, as I'm walking the dog, very informative, topical, and interesting listens.
Kind of gets the brain churning.
A little bit, yeah. Just different ways to think about things. You know, should you finance or lease a car, or should you buy or lease a car? Different ratios to live by. Once a year they put out how should you be doing at a certain age. So interesting things like that.
Great content there. So on your personal journey, I know we didn't get into this specifically during this episode, but tell us a little bit about where you're going to be in 5 years. Where does your personal financial independence journey look like, and where's it heading in 5 years' time?
Yeah, so kind of, you know, where it started is understanding that I need multiple streams of income, or would like to have multiple streams of income. So start to invest in different types of real estate, whether it's residential, commercial, trying to make sure that the investments cash flow, putting money away each month, you know, regardless of whether the market's doing well or not so well, putting some money away into retirement accounts. Having different types of side businesses. Not, you know, I have income that comes from both the financial advising side and tax and accounting side. So while they're both very related to each other, making sure that you're able to diversify yourself. And I think that anybody should be, if you have a W-2 job or if you have your own business, just not reliant on, you know, one particular client, one particular business, one particular industry. The more that you can diversify yourself, the better it's going to be. So for me to be able to continue to do that is what I try to do.
Add streams and diversify and make those incomes grow.
And then pay yourself first. That's number one, will always be number one, because you pay yourself first, the money's always going to go to you.
Gotcha. Cool. Well, I think with that, I think we can wrap it up. If people want to get in touch with you, Heath, what's the best way for them to reach out to you?
People can either call or email me. My phone number is 301-327-1040. And then my email address would be hchavis, HCHAVIS @ibcgrouptax.com.
I got one recommendation for your phone number. You got to change the last 4 digits to 1031.
That's right.
Instead of 1040, you know, the
Yeah,
personal
there you go.
I think that'd be pretty cool. Well, with that, we appreciate everybody joining us, and we'll catch you guys next time.
See you guys.
Thanks so much.
Thank you for listening to the Real FI podcast, where you learn from the investors that have lived the hard lessons for you. To connect with us during your pursuit of financial independence, be sure to join our community by following us on Instagram or emailing us at info@therealfi.com. If this content made you financially, mentally, physically, or spiritually richer, please make sure to leave us a positive review on your preferred content platform. Cheers to kicking the 9 to 5.